Derivatives and risk management. Derivatives and risk management in CFA Level 3 focus on using financial instruments strategically to modify portfolio exposures, manage uncertainty, and improve implementation efficiency. The curriculum emphasizes that derivatives are not solely speculative tools but essential instruments for hedging, rebalancing, and achieving targeted investment outcomes. Candidates study options, futures, forwards, swaps, and volatility derivatives within the broader context of portfolio management and institutional investing. Risk management involves understanding how these instruments affect return distributions, liquidity exposure, leverage, and portfolio sensitivity to market changes. The curriculum also highlights the importance of aligning derivative strategies with investment objectives, risk tolerance, and regulatory constraints. Effective derivatives management requires disciplined analysis, accurate pricing, careful monitoring, and a comprehensive understanding of market dynamics and counterparty risks. Option strategies form a significant portion of the CFA Level 3 derivatives curriculum because they provide flexible tools for managing downside risk and enhancing portfolio returns. Candidates study covered calls, protective puts, collars, bull spreads, bear spreads, straddles, and calendar spreads, analyzing their payoff structures, break-even points, and risk-return characteristics. The curriculum emphasizes understanding maximum profit, maximum loss, and expiration value under varying market scenarios. Volatility skew and volatility smile concepts are also introduced to explain differences in option pricing across strike prices and maturities. Candidates learn how options can replicate asset exposures or alter portfolio sensitivity to market movements. These strategies help portfolio managers achieve specific objectives such as income generation, downside protection, volatility trading, or tactical market positioning. Swaps, forwards, and futures are extensively studied because they allow efficient modification of portfolio exposures without directly trading underlying securities. CFA Level 3 explains how interest rate derivatives are used to manage duration, yield curve exposure, and fixed income risk. Currency forwards and swaps are applied to hedge exchange rate fluctuations or express tactical currency views. Equity futures and swaps provide cost-effective methods for adjusting equity exposure, implementing tactical asset allocation changes, and managing cash equitization strategies. Candidates also study volatility derivatives and variance swaps, which provide direct exposure to market volatility expectations. The curriculum emphasizes that derivatives improve implementation flexibility and reduce transaction costs, but they also introduce leverage, liquidity, operational and counterparty risks that require disciplined oversight and comprehensive portfolio risk management frameworks. Currency management is a critical component of risk management because global portfolios are increasingly exposed to foreign exchange fluctuations. The curriculum examines how currency movements affect both portfolio returns and overall risk characteristics. Candidates study strategic and tactical currency management approaches, including passive hedging, active currency overlays, and dynamic hedge ratio adjustments. Various active trading strategies based on economic fundamentals, technical analysis, carry trades, and volatility expectations are explored. The curriculum also discusses forward contracts, foreign exchange swaps, and cross-hedging techniques used to manage multi-currency exposures efficiently. Emerging market currencies receive particular attention because they often involve higher volatility, liquidity constraints, and political or economic instability. Effective currency management therefore plays an essential role in preserving portfolio value and improving global diversification outcomes. Risk management in CFA Level 3 extends beyond derivative instruments into broader portfolio construction and investment governance considerations. Candidates learn how derivatives can be integrated into asset allocation, portfolio rebalancing, and risk budgeting frameworks. The curriculum emphasizes stress testing, scenario analysis, and sensitivity analysis to evaluate how portfolios respond to changing market environments. Effective risk management requires understanding correlations, liquidity risks, tail risks, and the interaction between multiple asset classes during periods of financial stress. Candidates also study how derivative positions can unintentionally amplify portfolio volatility if leverage and concentration risks are not properly controlled. These concepts reinforce the importance of combining quantitative analysis with sound judgment and governance processes to maintain portfolio resilience under uncertain market conditions. Overall, the CFA Level 3 Derivatives and Risk Management curriculum integrates advanced financial instruments with practical portfolio management applications. Candidates are expected to evaluate derivative strategies not only from a return perspective but also in terms of liquidity, operational complexity, counterparty exposure, and alignment with investor objectives. The curriculum demonstrates how options, swaps, futures, and forwards can improve implementation efficiency, reduce transaction costs, and provide targeted risk exposures across asset classes and currencies. At the same time, it emphasizes that successful risk management depends on disciplined oversight, ethical decision-making, and comprehensive understanding of financial markets. Mastery of these concepts prepares investment professionals to manage sophisticated portfolios effectively within increasingly complex and interconnected global financial systems.